Welcome to this lecture on donations tax. Now, donations tax is a fairly simple section in the Act, but it is also an important section because it is a section that can pop up quite often in exams and in tests. Won't usually count a lot of marks in those situations, but it's important to know about it. So let's quickly talk about donations tax before we jump into what it's about. So what is donations tax? Donations tax is a tax that you make if you, or have to pay if you make a donation. So if I make a donation, so I give someone money, I might have to pay donations tax on that. Now that seems a bit strange, but the reason for why donations tax exists is it exists to combat people that are trying to avoid estate duty. So when you pass away, if you die, you have to pay estate duty. Now estate duty, basically, we're not going to look at the details of that now, but it's basically been at 20%. So if you die, they take your assets, right? Again, guys, this is very simple, but in very simplistic terms, it's not how it works in reality. That's a whole study section on its own. But let's say your assets were worth 10 million rands, then the estate duty on that will be basically 20% of that, 2 million rands. Now that 2 million rands gets paid out of your estate. So your family and your friends, or even people you wanted to benefit from your estate, will lose out on that money because it gets paid to SARS. So people don't like paying it. So what they then started doing is, when they were lying on their deathbed, they would say, okay, I'm donating all of my assets, so when I die, I have no assets because I've legally donated it to someone. So that was a way in which you could avoid estate duty. So that is why donations tax was introduced, and again, there's more than one rate, but 20% is the most common one, 20%. Donations tax was introduced at 20%. In order to stop people from getting rid of or avoiding estate duty in that way. That's basically its main reason. Now, estate duty has things and abatements in it of 3.5 million, for example. Donations tax has 100,000 rands a year. So donations tax is actually more expensive. So they're trying to discourage you to make donations. You will see though, if you make donations to public benefit organizations, or if there's, for example, someone that is sick and you make a donation, then you don't have to pay donations tax. You'll see there are exemptions to the rule. But they're just trying to stop people from moving around assets without proper selling them. Right, so basically, guys, that's what we've been talking about here under the introduction. It's to combat the avoidance of estate duty. It's to combat the avoidance of income tax generated by assets. So, for example, let's say here is Mr. X. Mr. X is currently paying tax at 45%. He is 40 years old. He has a son, Junior, who is 8 years old. Junior doesn't earn any income, so he's being taxed at 0%, or the first tax bracket for individuals is 18%. So if you earn the same thing, he'll be taxed there. So Mr. X has a block of flats that he earns. He takes that block of flats and he donates it to his son. Because let's say after he's donated to his son will pay a maximum of, let's say, 31% tax. So that's a way to avoid income tax by making a donation again. Again, there are consequences to that then that you'll study separately. We are going to look at the donations tax consequences here. So guys, CGT can affect income tax and CGT. And basically, like I've mentioned to you, it is very easy to incorporate it into almost any question. What do you need to look out for? You need to look out for situations where property, assets, money move between people not in an arm's length transaction. So look at situations where it's given away for free or sold at less than its market value. That's usually an indication that you should consider donations tax. So when do we raise donations tax? Section 54 tells us when to do this. So guys, if these three requirements are met, there is donations tax. There must be donations tax if there is property that has been donated by a resident of South Africa. So, quickly let's talk about it. Section 55, the definition of property says, property means any right in or to property, movable or immovable, corporeal, incorporeal, wheresoever situated. So what does that mean? It means movable property or immovable property. So, a computer or furniture which is movable, and immovable land, right? Those are both form part of property. Corporeal, tangible, so things you can touch. Incorporeal, intangible, things like trademarks. Wherever it is situated, so whichever country it is. Right, that's all property. I want you to make a note here, you'll see it also in the notes, but not services. Right. If I donate property, there will be donations tax. But if I donate my services, there's no donations tax because there's no property. Right. Donated. Section 55 says the definition of donated means donation means any gratuitous disposal. Gratuitous disposal means something where you've given away something for free of property, including any gratuitous waiver or renunciation of a right. So basically what they're trying to say, gratuitous means if you're giving something almost out of gratitude, I would want to say. So what I'm trying to say is it's something where you are giving something away for less than its market value. Now, I've got a quick discussion on that. What does it mean? They say here, you must look out for genuine benevolence. This is what court cases have said. There must be genuine benevolence. Right, genuine benevolence. Genuine means real and benevolence means kindness. So, you must not get something in return. Okay, so if I say, here I am giving my ex-wife 500,000 rands, but it's because I've made an agreement with her that I'll never want to see her or the children again, then that 500,000 is not genuine benevolence, it's not a donation. So see how strange this works so far. This means if you are being genuinely, really benevolent, really kind, then you pay donations tax. But if you're getting something in return for it, then it's not a donation. Right, that's an interesting way it works, because there will be other implications then. And it must be a South African resident. Right, which you'll discuss, which you'll study under gross income a bit more. So guys, property, like I've already discussed, here's the definition. Important there, guys. It is not services. So if Mrs. Y provides consulting services for free to a friend, that would cost 1,000 rands. Usually, she gives it for free to a friend. There's no donations tax. But if you donate property, houses, cars, boats, planes, money, painting, furniture, clothing, appliances, etc., all of that will be property. Right, residents, guys, you must be a resident of South Africa. This does not apply to non-residents. Right, so important. If a non-resident donates property that is situated in South Africa, there might be income tax implications, but we're not talking about that now. We're talking about donations tax. There will be no donations tax implications. Right, and donation, guys, like we discussed, it's a gratuitous disposal. You must not get anything in return for it. So, examples. Mr. X gives money to his son, wife, friend, a stranger. Mrs. Y sells property to someone on credit and then writes off the debt. Mr. Z sells goods worth 500 to someone for 300. The 200,000 difference there is a donation. What is not a donation? If you give property to someone for free, but in return that person agrees to do something or give something to you, then it is not really free. Right, so those are the basics, guys. Be on the lookout for those.